Many executives with equity compensation are heading toward an unpleasant tax prize, and they don't find out until April, when the year is already closed and there's nothing left to do but write the check. Not because they made bad decisions, because four landmines are built into the structures of how equity compensation is taxed, and nobody explains them when you sign the paperwork. I've seen every one of these cost executives six figures. Today, I'm going to show you what they are and what to do before the window closes. I'm Klemm, the founder of Inflection Wealth Management. We work with executives in tech, finance, healthcare, and energy who are navigating exactly this kind of complexity. The villain here isn't your CPA. It isn't your employer. It's the enrollment process itself, a system designed to process compensation, not to protect you from the tax consequences of it. When you sign the paperwork on your equity grant, the holding periods, the AMT triggers, the withholding gaps, they were all disclosed in footnotes, in plain documents, in language designed for clients, not clarity. The problem is, most of those decisions are one-way doors. Miss the deadline, misread the holding period, exercise the wrong number of shares in the wrong year, and you're locked in. You can't undo it. When your RSUs vest, your company withholds taxes automatically. Federal withholding comes out at the supplemental rate, 22%. Most executives see that and assume the tax piece is handled. It isn't. If you're earning $600,000 in salary and bonus, your federal marginal rate is 35%. That's a 13% gap on every dollar of RSU income. On a $200,000 vest, that gap is $26,000 before state taxes. In California, New York, and New Jersey, the combined gap can exceed $50,000 on a single vest. That money doesn't show up anywhere in your pay stub. It builds silently and arrives as a surprise in April, at which point the year is over and the only option is to pay it. The worst part isn't the amount, it's that this was entirely predictable in Q3 and entirely unaddressable in April. The fix: every Q3, run a projection. Compare your actual marginal rate to the supplemental withholding rate. Make estimated payments for the difference before December 31st. Incentive stock options may be one of the most tax-advantaged equity instruments available to executives. Done correctly, gains are taxed at long-term capital gains rates, 15% to 20%, depending on your income, instead of ordinary income at 32, 35, or 37%. For most high earners, the long-term capital gains rate is 20%. That applies above roughly $583,000 of taxable income for married filers. Below that, it's 15%. The difference on a $500,000 position is $75,000 to $110,000, depending on your bracket. Miss one date by a single day, and it's gone. ISOs require 2 holding periods for qualifying treatment, 1 year from exercise and 2 years from grant. Both must be cleared. Most executives track one and forget the other. But the deeper trap is AMT. When you exercise ISOs and hold the shares, the spread, market price minus strike price, is added to your alternative minimum tax income, even though it's not ordinary income. Exercise a large block in a single year without modeling the AMT exposure first, and you could potentially owe hundreds of thousands of dollars on paper gains you haven't sold. At a private company, you may not even be able to sell shares to cover it. The fix: model the AMT exposure before you exercise, not after. Know your AMT capacity for the year and track both holding period clocks, not just one. Employee stock purchase plans feel like free money. Buy company stock at a 10 to 15% discount. But the tax code has a holding period requirement to get preferential treatment. You have to hold the shares for 2 years from the offering date and 1 year from the purchase date, both. Miss either one, and that's a disqualifying disposition. Now here's where it gets more expensive than people expect. The ordinary income piece isn't just the discount, it's the full spread between the market price on the day you purchased and what you actually paid. If your plan had a look back and the stock moved up during the offering period, that spread could be a lot bigger than 15%. All of it gets taxed at ordinary income rates, potentially 35 to 37% for married couples filing jointly at higher income levels. And most people don't find out until the 1099-B arrives and the cost basis doesn't match what they expected. This one is subtle and expensive. You have a salary, on top of that a bonus, on top of that RSUs vesting, on top of that realized gains from ESPP or options, all in the same year. Individually, each is manageable. Together, They can push you from the 32% bracket into the 35% bracket, or from 35 into the 37% bracket. And when income is compressed in certain months, bonus season plus vesting, you can hit the top brackets mid-year without even realizing it. This is where quarterly estimated payments become critical. The withholding on your base salary almost never covers the full picture when variable income stacks on top. A mid-year income projection starting in Q2 can prevent an April surprise. Here's what connects all four. The tax code disclosed every one of these. The enrollment documents were accurate. The company followed the rules. But the system was never designed to surface the consequences clearly. It was designed to process compensation and maintain compliance. The tax implications were your problem. And most executives didn't know they had a problem until after the year closed. Conservatively, an executive who walks into all four of these in a single year could face a tax surprise bill of more than $50,000. For every year they continue without a plan, that surprise is waiting for them in April. If you're holding vested equity, have a bonus coming, or have RSU scheduled to vest before December 31st, and you haven't run a mid-year projection, that window is still open. But the window closes December 31st. Every one of these landmines has a date attached to it. After that, there is no fix. There is only a check. This channel is built for high-earning professionals and executives delivering content on navigating complex financial decisions, equity compensation, tax strategy, retirement planning, and concentrated wealth. If these topics are valuable to you, be sure to subscribe so that you get more free content. Thanks for joining. See you next time.